Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they're influential people, and what they say matters a lot because of their experience and background. So I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully it'll give you a wide and useful perspective. For all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description. With that out of the way, let me get started. Just over the past 2 years, we have witnessed AI explode into our daily lives in ways that seemed impossible just a short time ago. But there's a darker side to this AI revolution. A lot of money is pouring into AI right now, but no one really knows what the returns will be like. That's normal for investing, but some experts are warning that this might actually turn into one of the biggest bubbles we have ever seen. David Ayonon, the hedge fund manager famous for his bet against Lehman Brothers before the 2008 crash, recently warned about the frenzy of money going into AI. The numbers that are being thrown around are so extreme that it's really hard to understand them. He further said that there's a reasonable chance that a tremendous amount of capital destruction is going to come through this cycle. While he expects AI will ultimately surpass today's bullish forecast, he questioned whether spending $1 trillion a year or 500 billion a year will deliver good outcomes for the firms making those investments. To see why he is worried, just look at the numbers. In the past 6 months alone, Meta, Google, Microsoft, and Amazon have poured $100 to $200 billion into chips, data centers, and other infra. That's on a scale we haven't seen since the computer boom of the 1960s or even the railroad rush of the 1880s. AI spending is already reshaping the US economy. Just last quarter, money going into AI grew faster than the overall consumer spending. Without it, overall economic growth would look pretty weak. Economist Paul Kedrowski points out that AI investment as a share of GDP is now bigger than the dot-com boom. About 60% of the stock market gains over the past 2 years have also come from AI-linked companies. Take that away and returns would look bleak. By the way, Enron isn't the only skeptic. About a year ago, Paul Singer's Elliott Management, the infamous activist investor, said Nvidia was in a bubble. Many of AI's supposed uses are never going to be cost efficient, are never going to actually work right, will take up too much energy, or will prove to be untrustworthy. AI data centers being built in 2025 will suffer $40 billion in annual depreciation while generating only 15 to 20 billion in revenue. The depreciation literally exceeds revenue by 2x. To just break even on depreciation costs, the industry would need $160 billion in revenue at 25% gross margins. But today's AI revenue runs at only $15 to $20 billion. That means revenue needs to grow roughly tenfold just to cover depreciation costs, and that's before any profit. For a reasonable 20% return on investment, the industry would need $480 billion in AI revenue. The analysis concludes there just isn't enough revenue to cover the current capex spend. The world just doesn't have the ability to pay for this much AI. Still, the companies building AI's backbone aren't slowing down. They openly admit the risks but keep spending anyway. OpenAI Sam Altman recently acknowledged the bubble concerns directly in an interview with The Verge. He said, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes. Is AI the most important thing to happen in a very long time? My opinion is also yes." But rather than pulling back, Altman doubled down. You should expect OpenAI to spend trillions of dollars on infrastructure in the not so very distant future. And you should expect a bunch of economists to say, this is so crazy, it's so reckless and whatever. And we'll just be like, you know what, let us do our thing. Mark Zuckerberg has been equally blunt about the risks of falling behind. In a recent podcast, he admitted that the AI spending might represent a bubble, but argued, I think this administration for a number of reasons is definitely more forward-leaning on wanting to help build out infrastructure. When pressed about potentially misspending a couple of $100 billion, Mark Zuckerberg responded that the risk is higher on the other side, meaning that the risk of not investing enough and losing the AI race. Meta announced that it would invest at least $600 billion through 2028 in US infrastructure, with Zuckerberg emphasizing that being out of position on AI would be worse than overspending. So where does this leave us? On one hand, the skeptics are right. The numbers are staggering, and history offers a plenty of examples where massive infrastructure booms left behind wreckage for investors. On the other hand, the builders are chasing once in a generation platform shift, where the risk of sitting out looks even greater. Now, we don't really know how it all ends. What do you think? Are we watching the early stages of a lasting transformation or the making of the next big bubble? Global consulting giant Accenture is going through a massive game changing makeover. Led by its maverick CEO Julie Sweet, Accenture is bracing itself for the age of AI. It recently announced that it will lay off staff that could no longer be retrained for AI, having already laid off 11,000 people in the last 3 months already. This is probably one of the first overt instances of a company laying off a large part of its workforce explicitly because of AI. Here's what she said on a call recently. Our number one strategy is upskilling. Given the skills we need and we have a lot of experience in upskilling, we are trying to, in a very compressed timeline where we don't have a viable path for skilling, sort of exiting people so we can get more of the skills in we need. These cuts are a part of a broader $865 million company-wide restructuring program. In fact, these cuts will allow Accenture to continue the trend of their operating margins extending by at least 0.1% every year, defying analyst expectations that an economic slowdown might hurt that trend. Almost all of it is because of Gen AI. Under Sweet's leadership since 2019, Accenture has been an early adopter of generative AI, even opening a separate AI services vertical for all its Gen AI related bookings. In fact, she has acknowledged how companies are taking to AI faster than any other technology in history. It is well recognized that advanced AI has taken the mindshare of CEOs, the C-suite, and boards faster than any technology development we have seen in the past few decades. However, she also mentioned that hasn't translated into numbers yet. At the same time, as reported widely, value realization has been underwhelming for many, and enterprise adoption at scale is slow, other than with digital natives. Except Accenture is not one of those underwhelming companies. Their Gen AI bookings alone made $5.9 billion in revenue in FY25. As a whole, the company grew by an impressive 7%, recording around $70 billion in revenue and 15.1% operating margins. The thesis she is backing on is AI adoption at the enterprise level is actually hard. So Accenture will help organizations make the transition first before actually building AI products for them. And here's the thing, the leadership of Indian IT is feeling Accenture breathe down their neck. CLSA reports that Accenture is slowly but surely eating into the market share of big Indian IT companies like TCS and Infosys. It is still the only IT giant present in India that has publicly reported how much of its business is directly attributable to Gen AI. 44% of Accenture's employees are in India, making us the largest base for the country. And Accenture only expects India to be one of its most important markets in the future. The company name Accenture doesn't exist in the dictionary. It was actually derived by an ex-employee as a shortening of accent on the future. Turns out in the age of AI, they seem to be living up to their name. Now, Ray Dalio thinks the world moves in slow 80-year-long cycles. As any cycle comes to an end, existing powers fade and new ones take their mantle. Now, is he correct? That's a little hard to tell. History doesn't always fit into neat patterns and narratives. But he's certainly an extremely influential thinker, apart from running one of the world's biggest hedge funds. While you might not trust his predictions, he certainly has an interesting and nuanced sense of how the world moves. He recently made an appearance on the Diary of CEO podcast, and from the looks of it, he seems to see another turn of the 80-year cycle underway at the moment. The English-speaking world, he thinks, is in a deeply precarious position. The host of the podcast, Stephen Bartlett, is British, which is why naturally he began by asking Dalio whether he was optimistic about the future aspects of the United Kingdom. Dalio's answer, though, was a firm no. Here's what he said.
Because it has high debt, it has the social internal conflict, it's affected by the geopolitical factors, and in terms of inventiveness, it doesn't have the culture that other countries have, like the US. Is that accurate?
Yes, the culture and the capital markets to support that at a scale that it needs to be supported to play seriously in the game.
The United States, to him, is somewhat better. Unlike Europe, which he describes as an establishment culture, the United States is relatively more willing to reward talent even when it looks unconventional. As he says,
The U.S. has a culture of entrepreneurship, inventiveness. This is a whole different culture. Like in Europe, generally speaking, and in the UK, there's an establishment culture, right? And here, you could be 25, have a blue streak in your hair, and have the talent. But if you got the talent to pull it off, you can get the resources and you can be an entrepreneur. There's a culture of that. That means that it's happening more.
crucially, however, he is not optimistic about the United States either. To him, the country has too much debt and its people are increasingly at each other's throats, both of which are bad signs. As he says,
It definitely has this debt money economy problem. We can get into that. Okay. It definitely has the internal conflict power in which there's a fight between the left, the hard left and the right due to wealth and values gaps and people not believing that the system will work for them. And so democracy is at risk.
now it's not like the United States has collapsed. Large parts of the United States remain extremely productive. The problem, however, is that a majority of the country has fallen off the wagon and they've started resenting the system. That's where problems arise. To him, right now there's a war between the cream of American society, which is exceptionally productive, and the rest of America, which is falling behind.
You can't make generalizations about the United States, and you can't make generalizations, by the way, about the markets either. What you see is 1%, a small percentage, 1% of the population, if you're looking at the breakdown of incomes and also you're looking at the innovation, the stock markets, which stocks are doing well, who owns those companies, and all of that, about 3 million people in a country of 330 million people are really unbelievably doing great. And you could pick the neighborhoods they're in and what they're doing. And then there's the top 10%, let's say, which is the people around them, and they're really, really doing great in that world. At the same time, the bottom 60% of Americans have below a sixth grade reading level.
Wow.
And that population, in terms of the basics, being productive, you have to be productive and be prosperous. So what you need to have a successful society is to have broad-based productivity and prosperity. Okay, and that's a problem. Okay, so which America are you looking at? And are you watching the war that's happening between these?
There are other threats on the horizon as well. A competitor, which is China, has announced itself on the world stage, and new technologies like AI and robotics threaten to replace us altogether. We might be at another turn of Dalio's cycles. Times of such profound change are scary. Everything you thought you knew about the world is already outdated. The old ways of doing things are dying. How do you make your way through life amidst such uncertainty? As Dalio says,
there's a saying in Hong Kong, a Chinese saying, which is a smart rabbit has 3 holes. And what that means is you can see, is it the UK or the US? And I can then move to the better place and get out of the place that's a terrible place. So can I successfully be an immigrant or whatever and change my location throughout history? That's been important. So the ability to go to good places and away from bad places.
now apart from that flexibility, you also need the finances to cushion yourself against a shock.
Building your financial strength is important, which has to do with how you earn, spend, and save. That will determine the amount. And then what you do with that amount is invest. And so how you invest is also important. So if you have your financial ability and you can make the move, and then you have knowledge, about what's happening so that you can change things, those are the things you need.
Now, ultimately, you have to make peace with the cards you have been dealt and have the flexibility and finances to make your way out. In a world where most playbooks are falling apart, maybe this is the only playbook you need. That's it for this episode. Please let me know if you have any feedback for me in the comments below. David Ionon, the hedge fund manager famous for his best. David Ionon, Ionon,
David Ionon, David Ionon, the hedge fund manager famous for his bet. David Ionon, David Ionon, the hedge fund manager famous for his bet against the Lehman Brothers.